Hi, I'm Nanette Nokan. In the next edition of It's About Money, we'll be talking about reverse mortgages and trying to unravel the mysteries of what that's all about. Join us at the next edition of It's About Money. Hello and welcome to another edition of It's About Money. I'm Nanette Nokan and thank you for joining us. I have a wonderful program here for you today and a topic that many people are confused about or don't know much about. And we're fortunate to have two experts in the Rochester community to talk about reverse mortgages. My first guest is Jane Harrington. She's the Vice President at M&T Bank, Reverse Mortgage Sales Manager, and she's a certified reverse mortgage professional. So I welcome you here, Jane.
Thank you very much.
And my other guest is Chris Saraceni, and she's been a reverse mortgage specialist with M&T Bank for 3.5 years in the Rochester region.
Thank you.
Welcome as well. Thank you very much for being here. So what is the biggest misconceptions of reverse mortgage? And people are so afraid of it, but I think it can do a lot of good things. So talk to me about that.
I think the biggest misconception people have is they give away their home. Most people think the bank takes their home, which is totally not true. There's absolutely no change on their deed. They own their home just like they did with a regular mortgage or a home equity. So there's no fear about losing your home. I think the second largest misconception is they can't leave their home to their children someday in the future. They're certainly eligible to because they have control of their home. The only thing that has to be done is the debt would be paid off. Again, no different than a regular mortgage or a home equity. The last is when people think that they can't ever sell their home or move, and that is not true. So those are our biggest misconceptions that we find people still have today.
Now, what about property taxes and insurance? What is the responsibility of the borrower, of the homeowner, when it comes to reverse mortgages?
The homeowner is always responsible for their property taxes, homeowner's insurance, and general maintenance. Because again, you haven't given your house to the bank, so we don't come and mow your lawn or take care of your taxes. You have to take care of your own taxes, property insurance, and maintenance on your home for the lifetime that you live there.
Sure. Okay, sounds good. So tell me about what is a reverse mortgage and what is the actual definition of that?
Sure. The reverse mortgage is a great opportunity for homeowners 62 and over to be able to convert their hard-earned equity into cash without making monthly payments.
So it's basically a mortgage, but it's truly a reverse of the mortgage. Instead of paying into it, they're able to pull some money out.
Exactly like the name suggests.
Okay.
The bank pays the consumer, the borrower, instead of the borrower paying the bank.
And then at the very end, at the time that the home is given up is when the homeowner has to pay, or the estate of the homeowner has to pay back the amount borrowed.
Mm-hmm.
Okay, great.
Correct.
Let's see. What about, one of the things I think about reverse mortgages is it works kind of like a lease on a car. If you lease a car, you're still responsible for putting gasoline in the car. You still have to do the oil and filter change and the tire pressure check and all that stuff. So in a way, it's sort of like that. The homeowner owns it, the car owner owns the car. You're responsible for the things that go with it, but you're able to access the cash.
I always tell people, you thought you owned your house and you know you owned your house when you bought it and you took out a regular mortgage. What the reverse does, clearly similar to a car, if you have a car note, you still own that car and you take care of your car because you want it to last forever.
Sure.
So your home is your castle, it is your place that you're going to reside. You're getting to use the money today without having to sell your home to get your additional cash flow.
Sure. Okay, it's a great way to explain that. Now, there are different types of reverse mortgages. What are those? Some of the types out there?
There's two different types of reverse mortgage. The most common is our reverse mortgage, works as a refinance, where the homeowner already owns their primary residence and they're able to do the reverse mortgage on that home. Secondly, you can use the reverse mortgage to purchase a new primary residence without making a monthly mortgage payment.
I see. So either the place that you're already living in, pulling the equity out of that,
Sure.
or going into a new home, a smaller one, a larger one, but
Downsizing, sure.
Yes. Okay. Got it. Okay. How is the interest on the mortgage determined? You know, right in the early 2010s, you know, the interest rates have been fairly low. How is that determined these days?
Well, on the interest rate, there's two ways to think about it. We have two different products. One is an ARM, which is an adjustable rate mortgage, and that will adjust on a monthly basis. Secondly, there is a fixed rate option, which many people are starting to select. That's fairly new. Within the last couple years, they came out with a fixed rate. So our ARM product is based on what they call the LIBOR, the London Interbank Offering Rate, and that will adjust. Our fixed rate, similar to other mortgage and home equity products, is based on the current market rate at the time your loan closes.
I see. So the lower the interest rates at the time of closing, the better it is.
The better for the homeowner, because your available equity is based on age, home value, and interest rate. So it's always nice to have a lower interest rate if you're going to lock in. The ARM and the fixed rate are both at an extremely low rate today.
And if you were to get a fixed rate, you really basically pull the equity out. It's not like a monthly payout.
No, a fixed rate does require that you take all of your eligible funds at closing, whatever has not been used to secure and pay off any liens you have on your property.
I see. Okay, so then the interest is based on the amount of
the full draw.
Got it, full draw. Okay. And what is negative amortization? What is that? Because people relate that to reverse mortgages.
The negative amortization, it's kind of a big word, but basically what it means is the balance of your loan will increase over time because every month the interest will be added to it. Unlike in the traditional, what we call forward world, you're paying principal interest every single month. So your loan balance will go down, and 30 years from now, you'll get a paid bill of sale. Ours is an increasing debt loan, hence negative amortization. Instead of your loan balance going down, it will go up over time to be paid off by the sale price of your home someday in the future.
So the longer we live, the higher that balance is. I mean, we hope to live a long time.
It will grow every year unless there is the provision. If people do want to make a payment, they can, but you're never required to. Our philosophy is you've worked hard for your house, let it work for you.
Sure, sure. Might as well, especially for many people who need cash flow.
Sure.
So in your experience, what are the most common uses of a reverse mortgage? When would be a time that people would do it?
In my experience, Nanette, people take, the reverse mortgage out to pay off an existing mortgage, relieve themselves of that monthly mortgage payment. Now they have that money to use on a day-to-day basis for day-to-day living expenses. I've also found that people use the reverse mortgage to just live every day, pay their daily expenses, let their portfolio, with their investments recover over time. People use the reverse mortgage for health care, in-home care, drug costs, prescription drug costs, making their houses handicap accessible.
Sure.
And I've also had a lot of people that have used the reverse mortgage where they're drawing the equity out of their home to purchase a vacation home.
Sure.
Take advantage of the, the great buys out there on vacations homes where it's warm and sunny.
I see. So basically, one would be looking at a financial need and using the reverse mortgage as a tool to finance that need instead of getting another loan elsewhere. You're using your house as collateral for that loan. And but you have to be at least 62, right?
Correct.
To be able to use it. Okay, great.
Everyone on the deed has to be 62.
Ah, okay.
So it's not just one of potentially two people.
I see.
And we do not ever recommend taking someone off because once you're not on the deed, you're not on the loan. So that's why we look for everyone to be 62 and over who is on the deed. That way, everyone is covered under the provisions of the reverse mortgage for the lifetime that they live in the home, whether one is living or both are still living in the home.
I see. Okay. So basically you have to be 62, and the closer you are to 62, the less of an amount you can pull out, right? And basically on the concept of it, the equity, because it's based on your age and the value of the home and prevailing interest rates.
Correct. The younger you are, the less you're going to get out of the house now because your life expectancy is longer.
Sure, absolutely. So now, what if the loan hits such a level that it's greater than the value of the home? What happens to the homeowner?
Nothing happens to the homeowner. That's the beauty of this product. You have the eligibility day one based on your home value today, not based on what the home value becomes in the future. That's why there is the mortgage insurance premium. This is considered a non-recourse loan. So when you or your estate sells your home, the only recapture of funds will be for the sale price of your home at the time it's sold. So nobody will ever kick you out because you've used up your funds, which many people think. But if you take all your money out day one, nothing is settled until you choose to sell your house whenever in the future or someday if your estate sells your home.
Right. There's a lot of, I think it's one of the misconceptions of a reverse mortgage. People say, gee, what if I lived so long and housing prices went down and now, do my children owe the money when I die? Or do I owe the money when I decide to sell the house? But you've just clarified that.
That is the beauty of this product. No negative debt will ever pass on to the homeowner selling or to their heirs or their estate. So nothing can be recaptured other than the price from the sale of the home. So none of their other financial assets would be touched.
Yeah, that's right. So in there, either like you'd mentioned earlier, Chris, that people can distribute money from their portfolio, or they could access the money from their home equity through a reverse mortgage and be able to finance the things that they need. So
absolutely
great. That sounds good. So what happens so we talked about dying, and what's the process of that? So if someone died, moved away, had to go to a nursing home, those are reasons not to be in the house, right? And you talked about nothing will happen to them in terms of paying back as it's a non-recourse loan. So tell me about the mechanics on that. I mean, what really happens? What makes that happen?
There's a residency requirement and an occupancy certification annually. So if a homeowner has moved into a health-related facility, they have 1 year to be able to get back to the home. So nobody's going to cut their legs out from under them if they're in a rehab center, have an extended stay in a nursing home. And again, this only applies if that is the last of the two homeowners.
I see.
If there's a couple and there's one person still at home, nothing would ever change. When the last person were to go into a health-related facility, that person has a year to get back.
I see.
Once that time passes, there's many other reasons why the reverse mortgage is called. Number one, your homeowner's insurance, you become a vacant home after 1 year. That becomes an issue. And you have to look at your own planning for staying in the nursing home, because you do have to keep the property taxes paid, the home in repair, maintenance done. So most people, we find, once they know they're never going home, usually start to settle and unburden themselves from that worry of a vacant home. If anyone ever chooses to move and they're not deceased, this is their home. They can choose that at any time.
Sure. And if they lived longer than the normal life expectancy and the market value of the home is lower than what it's sold for, well, actually, they owe more than what it's sold for. They don't have to pay it back. I want to underscore that,
right,
because I think that's a very, very important point.
Even for the individuals, Chris and I have both had many that 7, 8 years later, they're deciding to move closer to their children. If that should fall into that their debt is higher than the current market value of their home, they do not owe the difference. So it is a very, very beautiful protection for a senior in today's market.
That's great. That's great. I'm talking with Chris Saraceni and Jane Harrington, a reverse mortgage specialist, and we'll be right back.
Things can come and go quickly these days, but one thing has been sure and steady, and if you haven't noticed, it's been on the air for over 10 years now. Nanette Noken has been a Rochester Public Access television fixture. With her highly accredited financial background, viewers are sure to learn some tips of the trade. Her show, It's About Money, has been educating, informing, entertaining, and inspiring viewers since 1996. She and her guests have been giving valuable advice on how to invest, spend, and save your hard-earned money. And who's not interested in money? So tune into your public access station for a new monthly episode of It's About Money for Rochester's finest in finance.
And we're back. I'm Nanette Naukan from It's About Money. My guests are Jane Harrington and Chris Saraceni, M&T Bank specialist on reverse mortgages. Thanks again to both of you for being here.
Thank you for having
Thank
us,
you.
Nanette. This is a great opportunity.
Yeah. And then let's talk about the details of the reverse mortgage first. So the first thing that happens is the deed does not change, right?
Correct.
So basically what that means is if a couple owned the house, they will still own the house.
Yes.
Absolutely.
And you said that it's a non-recourse loan. So basically when they sell the property for whatever reason, right? Maybe moving, going to a nursing home or dying, if the value that it's sold for, the net proceeds, then they don't have to owe the money back. Right? So help me with one other detail. Let's say, for example, someone sells their house, and how does the commission play into that, like the real estate commission? Somebody had asked me that question. I didn't know the answer to it. So let's say, for example, a couple had a reverse mortgage, and they sold the property, and net of cost for the commissions, they got, let's just say, $300,000, and the value of the loan is $250,000. They keep the $50,000. Right?
Correct.
Okay. So there's no additional expenses. They're not given an extra credit for the commissions or anything like that.
No, if someone has a home for $300,000 and they put it on the market, traditionally you assume a 7% commission to the realtor, and then from the net, after that 7% is subtracted, the debt comes out and the residual will go to the homeowner if they're living, or to the estate if they are deceased.
I see. So basically, this is there's the numbers are exactly as they are. So whatever it's sold net of, the equity is the difference between what they owe the bank and what they have gotten.
And again, no different than if you sell your house with a regular mortgage.
Right.
Sale price minus the commission, minus the fees, minus the debt, and the rest goes to the homeowner.
Wonderful. Give me some examples of how, or at least an example of how the reverse mortgage works, depending on age.
We'll start with a 70-year-old individual. I'd like to say that these numbers, what we're going to be doing, I'd like to tell you how they're eligible for the money,
Okay.
and then compare it to the difference between if you're using it, as Chris said, for a traditional refinance where you're staying in your home, you're doing it on your existing home, or if you're looking to purchase. You'll see that it's really, the money is the same. It's just how you're going to apply using it.
Okay, sounds good.
So your age 70-year-old would be the youngest homeowner. That is how we calculate it. So if we have a couple, 70 and 74, everything is calculated on the age of 70. We're going to assume here, we find, Chris, I think 740 seems to be an average of
Average
our
home price.
home price.
Monroe
So
County area.
considering a 70-year-old and $140,000 home value, that individual would be eligible for between $84,000 and $87,000. From that, if that is on our traditional refinance and they have a current mortgage or home equity, we would pay that off, and they can have the additional either lump sum, monthly payment, 10-year payment, or a straight line of credit. The line of credit has a beauty. If you don't need to use the money, leave it there and let it grow. Unlike our home equity products of today, your line of credit will grow over time for your future spending. And it grows at 1.25% higher than the interest rate that is assessed on your outstanding loan balance. So it is a beautiful thing for people who are planning for their long-term money.
I see. Give them access.
Now, if you were going to purchase a house, the same scenario, 70-year-old is the youngest, $140,000, you would get the same $84,000 to $87,000 towards your home value, and then you would only have to bring approximately $52,000 to closing, and you would own a $140,000 home without ever having to make a payment.
I think that's a more recent development, isn't it, in a way?
Yes, that was started in 2009.
Okay, right. Because traditionally people didn't think of reverse mortgages as ability to,
Right.
that you'd have to buy the house first and then take a reverse mortgage,
correct.
which can be pretty costly for many people to do the transactions twice.
We've eliminated that step.
Yeah.
We were very lucky that HUD and FHA worked to allow that to happen because many of our senior clients look to relocate to warmer weather, be where family is, or downsize out of some of these very large multi-story homes into the beautiful patio homes that are all on one floor.
Sure.
So they really wanted to consolidate and allow for a single closing, single set of costs, and make it easier for all people to have access to a home they would like to live in for the remainder of their life.
I see. Now, for many people who would do this, it's because their funds may be limited, or like you said earlier, to just release the money and have it available for their goals and objectives. How many people are you finding? Is it common? What percentage of homeowners who are over 62 actually have this? Is there a number on that that's available? I wonder how many people actually realize that the product is there and actually pursue it because it's attractive. It's probably no numbers yet.
Well, I don't have numbers specifically for Monroe County, but approximately 80,000 a year in the country. A few years ago, it was a high of 115,000. So it's a growing in popularity. I think spreading the news and allowing individuals to realize it is definitely something to look into to maximize their lifestyle.
Sure, right. I think it just makes a lot of sense. I mean, people are afraid of not leaving inheritance to their children, but on the other hand, you have to finance your living expenses.
You have to live for today.
Right. So either you use your own resources that's out there, or you just kind of stop paying into it. So, if I take a homeowner who has, let's say, short-term debt of $65,000, and let's just say it's credit cards, their cash outflow for that is $1,000 a month. If they go into a reverse mortgage, they don't have to pay the $1,000 a month, right? And they may be able to pull some equity out of the house depending on their age and the value of the house. So there are closing costs in doing reverse mortgages, right, that one would have to take a look at? I mean, just generally speaking, I'm not asking for specific numbers.
Yes, there are closing costs, but most of the closing costs are financed right into the loan. So the out-of-pocket cost is very low for a homeowner to get into the reverse mortgage.
Okay. Got it. So it's not, they don't have to come up with any upfront money. It can be part of the reverse mortgage. What do you call that? Pulling the money out, take out? Or what is that?
They're eligible equity.
Eligible equity.
Yes.
Okay, thank you.
The one thing with these products, which is why we always suggest and try to educate people, sit down and talk with someone, because within the two products, the ARM or the fixed, there are different types of eligibility which will lower closing costs. So there are products with much lower closing costs.
I see.
It all depends on what you need. So there are different ranges of closing costs for the different products that are out there.
I see. So really, you have to really zero in on what your needs are and then understand the closing costs and that kind of thing. So, and from the time that someone decides to do a reverse mortgage, how long is the approval process?
Once we actually sit down to do an application, it's usually about a 4 to 6 week turnaround time.
I see.
We like to get the loan closed for them within that time period.
Okay, that's fair. Now, in some cases, let's say someone's having trouble selling their house, but they, or at least concerned about giving up a house that they found, and then they have some assets. Is there an eligibility that they have to worry about? So let's say, for example, someone is selling a house. Oh, actually, let's take this example. Someone already has a reverse mortgage on their house, and they have some cash, and they want to buy a smaller house, and they want to use their assets, their cash, to make the required equity on the house in order to move into it using a reverse mortgage. Can they have two homes like that? Or you have to have only one?
Just to clarify, they can have two homes, but if they had done a regular reverse mortgage on their existing home that now they want to sell, they would have to have that house sold. We can do a simultaneous close by.
I see. Okay.
The reason is the federal government will not allow more than one FHA mortgage
For each home.
at a time. So again, FHA mortgages are for primary residence. You can't own two primary residences.
I see. Okay.
Your prior home will become a secondary home.
I see.
But for the people who don't already have a reverse mortgage or another FHA product, you certainly can have and retain your other home, even though you intend to sell it. And for some people, we have found in our regions that they like to hold on to that home because it's not moving as quickly as they had hoped. But they do have, as you said, the required equity to purchase that new ideal home when it comes on the market. You can keep it. We just have to qualify that you can pay property taxes and insurance and maintenance on both.
I see. Oh, so it's
So
qualification.
it's a limited qualify if you're going to keep that other home. Even though it's on the market, it's still considered retained because it is not sold.
I see. Okay, I got it. So that needs to be very important in people's minds. They just can't. But the simultaneous close.
We
is
can do
probably-
the simultaneous close. Chris is very good when she sits down with someone of going through exactly what has to be done, what would make sense, when is the right time to move forward. No different than a contingent offer on a home does not work.
True.
Because it's not sold unless you can prove you can afford to keep both homes.
Yes. Okay. So they must do a credit check and some proof of income and.
For the purchase where they're retaining their second home, definitely.
Yes.
I see.
It's a proof of assets to be able to retain and maintain the second home.
I see. Very good. So really, the reverse mortgage should be an option. Citizens who are 62 or older, both owners have to be 62 or older.
Correct.
I need to take a look at that, and they really shouldn't be afraid of having to give up the equity because it's the same as having a regular mortgage with regards to the net equity on the house at the time of the sale. So that's really great. I think you have. I think it's a great strategy for many people, like you've mentioned before. But they have to just be careful because once they get into it. Okay, one last question. If someone just decides, okay, I've had it with the reverse mortgage just because they could not educate themselves of the fear of it, can they just pay it off and call
Anytime.
it done? Okay.
No prepayment. You're in total control. You can pay it off at any time.
Okay, well that's great. That's a great thing because then you don't want somebody to feel like they're so encumbered by
Still their
that
home.
strategy. Okay, very good. Well, thank you to both of you. It's really been a very informative session here to talk about reverse mortgages, and I hope that people who have any questions can call and find
Sure.
out more about it. And I appreciate that there's certifications and all that stuff, continuing education to know about it, because things have changed so much in the reverse mortgage world. So in a positive way.
We appreciate the opportunity. Education is power for all individuals. Know what you can do, and we are here to answer any questions that anyone has, whether they decide to do it or not. If you know what you can do, you will make the right decision.
Sure, and having an educated decision. Thank you. And thank you, our guests, for joining us. My guests today are Jane Harrington and Chris Saraceni, and they're reverse mortgage specialists from M&T Bank. Thanks again for joining us. Until next time, I'm Nanette Nokan.
Thanks for tuning in to today's show. If you have any questions for It's About Money, please email Nanette at nnocon@aol.com. This program was produced through Penfield Community Television in Penfield, New York.